What's up? Yo, yo, yo. Welcome to Forex.Today, the YouTube community of more than 19,000, almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis for US dollar, Japanese yen, euro, Great British pound, Canadian dollar, Aussie dollar, Kiwi dollar, Bitcoin, gold, oil, and more. Let me lose. Yeah, my microphones are all weird, huh? Anyways, I think you can hear me. Wow, even the camera is off today. Very strange. Anyways, hey, my name is Wayne. I'm a currency trader, just like you. My background is macroeconomics, global money flow. That's how I'm going to interpret the markets today. What I'm looking for is trends. I'm a global macro trend trader. So if you like that, ask questions, get involved, and I'll do my best to help. I also look at trading Forex like a business, not a get-rich-quick scheme. So if you're interested in running Forex as a small business, ask questions, get involved, and I'll do my best to help. If you're looking for a broker, I recommend tradersway.com. Why? Because they earned my loyalty and my respect through their actions and their executions. Not from a banner ad or a promise for cheap spreads. So they offer value to me, and I recommend them to you. The link is in the description below, or you can go to tradersway.com and open up a demo. Also in the description below is a link to FX Bootcamp where you can get 65 hours of training on how to trade foreign exchange professionally. Things like technical and fundamental analysis, central banking and monetary policy, day trading, swing trading, carry trading, all that kind of stuff is in there, and a much more. Oh, it's $88 a year. I know that's stupid low, right? So get on with it. There's also a link to my book, a link to free training if you need that. Whatever, man. It's all there. It's up to you. Step forward, step up, get big or stay small. Your call. But for those that put in a huge effort, I am here for you. So here he is, and here we shall be. Okay. Oh, Matrix is in a bad mood today? What's wrong, man? What went wrong? That's very strange of you to be like that. So what went wrong, buddy? Hey, my chat isn't working properly. What's going on? I guess I have to reload the page or something. All right, so let's go around the world. Take a look at what we have. Some dollar strength is resuming. Good morning, Roger. Yen is strong, so this is indicative of potential risk off. Swiss franc up. That's indicative of risk off. Aussie stalling out. Euro way down. Okay. CAD doing all right. Kiwi down. About the same as Aussie, right? And pound. So, hey, man, look at, are you on euro pound? SWS, why don't you go to the website, tradersway.com, and figure it out? Or contact support and work with them to figure that out. Patrick wants to know about the carry trade. Well, you simply visit the websites of the central banks and review the interest that they pay you. And compare that to the interest that you need to pay yourself. So this question had to do with carry trades. Okay? Okay? So what does it cost you to borrow a US dollar, Patrick? No. No, that is not correct. Try again. What is the Fed funds rate of the United States of America? Okay. So we'll look at this. The effective Fed funds rate now is 0.06 and currently is floating between 0.00 and 0.25. Okay. So Patrick, I invite you to join FX Bootcamp. It will cost you $88 US, but you got to know this stuff. Okay. But you're reading the book, which is good, but okay, you gotta catch up, man. That's all. Okay, so basically zero, but you could argue the actual answer is somewhere between 0 and 0.25. Okay, so you borrow a bunch of American dollars, and it's basically free. Okay. Then you take your dollars and you invest it into Mexico, and they currently, for the same rate, will pay you 6%. So if you borrow money in America, it's basically free, but let's say it's 0.25. Okay? Now, all that money you borrow, you plow into Mexico and they pay you 6, but you have a cost. So you get paid 6, but then you have to minus 0.25, which is the cost of the money you borrowed, and you get to take home 5.75%. Not bad, right? That's what we call a carry trade. Okay? Your income minus your expenses. Okay, is your net return of 5.75, which we call your carry. Now, if you are leveraged, okay, that means your internal rate of return, if let's say you have an account outside the United States and you're leveraged 100 to 1, your internal rate of return on this investment is 575%. Roughly speaking. You have other costs that go in there. It's probably a little bit lower, but that's the easy math, right? And that's on interest only. That doesn't include pips. So if you set on the trade for 1 year, you're short USD peso. Okay? On the 165th day, you get knocked out at break even. On day 365. Which means you made 0 pips. Okay? But for every dollar in your account that you invested, okay? For every dollar you invested in your cash, you receive $5.75 back. Okay, so if it was a standard lot and it cost you $1,000 to get you 100,000 US dollar position, then you would have had $5,750. And you didn't earn any pips. That was just interest that you collected. So does that exist? Yes. Now, this is a great example. And not long ago, it was 4.5%. It's already up to 6% and probably going higher. But so is the Fed funds rate. So now you have to, your costs are going higher, but your income is going higher too. So you're like, well, Wayne, why don't you just tell me all the high yielders? I would push back and say, well, why don't you spend a day and go through every central bank you can think of and figure it out and put it down in an Excel spreadsheet? And you're like, I'll just ask Google. No, do the work. Do the work. Bookmark every time you go to like the Bank of Romania. Good, bookmark it. Spend some time on it. See if you like it. See if it's easy to figure out. Maybe the Bank of Romania is difficult to figure out. Okay? But other central banks are not. And go around the world bookmarking and checking them out and reading them and finding some of your favorites, but also recording the swaps. Okay? Do the work. Tell you won't regret it. If you do the work, you're a professional. If you're trying to cut corners, you're an amateur. Pretty simple. Don't cut corners. Love the job. Love it, man. Own it. Be it. Be the pip. Patrick, be the pip. Don't even think like a pip. Be the pip. All right. Cool. So what's going on, Matrix? All right. Yeah. Maybe some other time, Patrick. All right. Okay. Down, 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 down. Up, up. Down, 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 down. Up, up. Down, 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 down. Up, up. Okay. All right, let me ask you, am I a dollar bull or am I a dollar bear? Let's make sure everyone's on the clue train. Oh, see, this is why I asked. No, your guys are wrong. No. Dude, I covered this all last week. No. I'm a dollar bull, as Lucas said, for the next 5 to 6 weeks. Okay? That's key. See, you have to we have to do this. We have to do this. In this period here, okay, I had this pair coming down, and all dollar pairs like euro dollar, pound dollar, Kiwi dollar, all that kind of stuff. Until this point in time. And yes, weeks and 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 weeks in advance, I talked about this. Then I said in February, dollar will weaken. Yeah, that's true. Okay, it's true, and it may continue to do this. It might. But what I started saying last week is I think whatever up move has happened could plausibly have completed itself. The move happened. I'm like, dude, dollar's going to get weak in February. I didn't say every single day for February. And go back in the videos last week and maybe even the week before. I was talking about this. Like this up may have already occurred. Like how high do you think it needs to go? Does it need to go way up here for that to happen? It could, but at some point I got to think what's going on here on the medium run. And the medium run is Q1, quarter one. Dollar is up. Okay? Okay? But inside of that, you have dollar weakness expected at the beginning of February. And I got that, bro. Okay? So I think this could be very, 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 very enlightening because that's the sell pivot for the month. So we went from way down here, which is the buy pivot, went all the way up, hit the logical target, and now could fall all the way to the Fed meeting. Now, in the day trading group and the swing trading group, I talked about the logic here of as we get closer to the event risk, it's a risk event. The closer we get to the risk event, the less likely new money is coming into this market, and the more likely old money is coming out. Okay? So anyways, this is sort of like the last place bulls can buy this week. Okay? So look where we are now. I want you to remember it. We're either going here or we're going here. Which one is it? How the hell would I know? What, am I a genie in a bottle? You got to rub me the right way. Okay? It's for you to decide. You're the professional. You're the money manager. Okay? So that's where we use technical analysis. Okay? To figure that question out. Okay? Lesso says we're going down. Good. Easy then, right? Which one was that? Aussie, right? Great. So that's easy then. This decision is made. Okay. See, a bear would have sold it here. Plan B was up here. Oh. Okay. Look, this is where bulls would buy. Bulls, bears. Okay. Who's going to win? Whoever put more money on it. Okay. So this is dangerous, right? Because you can keep changing the time frame. If I look at this at a higher time frame, I'm just going to see this. Trading this on a lower time frame, you're going to see the drop. Oops, that was supposed to be blue. Okay, you would see the drop, and then the rally, and then this, and then this, and there's all kinds of patterns you might be seeing here. You should supersede everything and be a bull or a bear. Darko says, Wayne, I said last time that is very smart, but I didn't say without. I think I'm missing something, Darko. Yeah, but the idea is it's a seasonal issue. Yes, Q1, right? Q1, I believe we're still talking about the dollar here. Q1 U.S. dollar generally goes up. But inside that, there are periods. So if you looked at January, February, and March, here's my general thought process. Okay? Remember, it's general. Down, up. Look at that. For some reason, it won't drop. Look at that. Up, and then down. Let's do it this way. Down, up, down. Okay? Go back 5 years ago, I'll give you the same speech. Okay, I'm not making this up. It's a general thought process. Even inside this January, okay, I believe there's an up inside of January. Okay, February is up, but depending on obviously what's happening in the central bank and macroeconomics, and now we even have geopolitical risk. Okay, you can get up, but it doesn't have to be for the full month. Do you understand? Like, it's a general purpose idea. So if in the first 3 days this thing rallies up 250, 300 pips, that could be it. And then, but what's the general? This general idea, U.S. dollars up. So, by the way, hope I'm not confusing you. I'm thinking like a euro dollar or something. Sorry, gee whiz. So down means dollar up. Geez, maybe this is where I'm screwing up here. Anyways, let's go back to this. So on a euro dollar, okay, I go in looking to sell the very first week. Like, I'm immediately getting ready to drop something like a euro dollar. Okay? Then I expect a big rally in February, but not the month isn't the issue. If the general plan is down, but there's going to be an up move, think of it, lower low, lower high, lower low. So if this drops, and then this rallies 300 pips, well, then if it happens in the first week, I'm already going to short March, but I could be shorting 2 weeks of February too. And you get a down in January, up 300 pips, and then down for the rest of February and all of March, right? Like, the calendar that isn't what you're trading, it's the price action. Okay? Alistair says, yeah, however, in each month there are up and down periods, but depending on the time of year and what's going on, certain periods of time have a lot less up and down. It could just be up, like for 6 weeks straight, 8 weeks straight, 9, 10 weeks straight. And the pullbacks are one day out of 5. Right? Down Monday, up the rest of the week. Actually, typically what it is, down Monday, you buy it. It goes up until Thursday, you take profit. It comes down on Friday, comes down a little bit on Monday, buy it, and off you go. Okay? So, right? So you have to know that first. Okay? And you'll see all these X's like, what does this mean, man? Okay? Well, it's important. Okay. Once you get the lower low, I mean, come on, guys. We went over this, right? Lower low. Okay. Grab the left shoulder. La, 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 la. Okay. Do you remember I was telling the difference between a head and shoulders pattern and a crown pattern? Okay. Anyways, so all I know is this is in this period is the general purpose of buying. Okay. Cool, right? Cool, great, right, great. Okay, so now what does the technical analysis say? Well, this was a big high, this was a low, this was a lower high, this was a lower low. Statistically speaking, you'd probably look for a lower high. We've already had one here. This is probably your second chance. Okay, you should know this is the sell zone today. Okay, and this is the sell zone for tomorrow. So we're kind of in tomorrow's sell zone. That doesn't mean it's going to fall, but it's part of your analysis that there's a trend going on here, 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 so on and so forth. Now, we happen to do this right at the beginning of the trading day. Cool. So if you are a bear, you're already looking to sell. You got your green candle pullback. Okay. Done, right? You're kicking it off the hourly 21. You're done. That's your trade. Then you say, well, Wayne, how do you know it doesn't do this now? I don't know that. I didn't say it wouldn't do that. I said, what's your trade plan? What are you planning for? What would you do? Well, I need the charts to tell me. If you fail. Okay? If you don't know, Australia is never going to raise interest rates. Okay? And you don't know the Fed's going to raise 7 times. Okay? Then forget it. Okay? You're trading blind. Just totally, grossly, negligently blind. You're telling me you want to race cars fast, but you don't like using steering wheels or brakes. Oh, good. Good. Yeah, don't worry about steering. Don't worry about it. That brake thing, don't worry about it. Just go fast, man. Hit it hard. Pedal to the metal. Go! Okay. So anyways, you got to make some decisions. So if you think this is down, okay, let me change this indicator. Bias pivots, bearish mode. Okay, see, it's really clear. You were supposed to sell here last night, and now this is tomorrow's trade, so that's probably what you're doing today. That's that. Right? Am I overcomplicating it? Huh? Okay, your biggest mistake is likely you don't have a fundamental plan. Okay? If you were a professional trader, and we could sit down, have dinner, cocktails, and a cigar, and you would tell me how much you like the British pound this year. And you would tell me fundamental reasons. You wouldn't tell me technically. So you're like, well, Wayne, I don't need fundamentals. Everything's in the price. I'd just say you're an amateur. And the fact that you're throwing away fundamentals and you're telling me they don't matter is horrible. It's ugly. Like, wow, really gross. The conversation probably end. Okay, you're totally right. Yeah, fundamentals don't matter. Monetary policy doesn't matter. Geopolitical, global money flow, global business economic conditions, trade deals and tariffs. None of it matters. It's all in the price. Like, it's gross. Like, okay, cool. You're so right. Good luck. Talk to you later. Okay? Now, am I so arrogant to come across and say that technicals don't matter? No. Technicals are hugely important, massively. I love technical analysis. I love short-term trading. I love medium-term trading. I love long-term trading. Okay? So on the reverse side of the equation, I'm like, I like everything that the technical only trader is doing because I love technical analysis and I understand enough of it. So even if you're doing something different, I should be able to look at what you're doing and figure it out and see the strengths and weaknesses and everything else. So I would have nothing but love for that other trader. But when then they say fundamentals and macroeconomics are meaningless, you don't need to know any of this, seasonality is worthless, everything is in the price, it just kills the conversation because it's dare I say, negligent. Yeah. So anyways, I would use your knowledge as a filter. Okay? Okay? So at Harvard, this idea of Illuminati comes from the word veritas, okay, which means the truth. But the translation is not just knowing the future kind of thing. Like the truth comes from knowledge, and the knowledge comes from research and work. And therefore, you are enlightened because of the hard work and research that you've done. That's where the enlightenment comes from, the idea of Illuminati. You're enlightened. You know the truth because you know the facts. You've done the work, and I like that. So I want you to have that to back you up, not just technical analysis. But again, I love technical analysis. I'm just trying to sprinkle some more on top of that. Okay, cool. So grow the knowledge. So you should know what you want to do with this. Now, I would probably argue when the dollar is weak, not that it's weak now, but when it's weak, this is a great one to buy. But because I'm bullish on the Great British Pound. But when the dollar is strong, this would not be a good one to trade. Down or up does not matter. So you got to know when to hold them and know when to fold them. Okay? Right now, dollar is strong today. Now, maybe you argue that's going to change. Cool. Then use your technical analysis to confirm or deny that hypothesis. Okay? Cool. Okay? Because you either have this going on, okay? And you know somebody's doing that. You can see it in the charts. You know that's probably at least half the market's plan. Okay? Or you think it's going to go here. Now, if you think it's going to go there, you might argue that it's going to go higher, but you technically shouldn't make that argument on the shorter run at least, because over the last, period here of over a week, it's done nothing. Because they've been both strong or weak at the same time. But you might argue going out further if you're looking out for the month, that you think by the end of the month it'll be higher. Well, on the shorter run, meaning this week, you can't really technically make that call until you're above resistance and then using resistance as support. So on the shorter run, technically, you need to stay within the last week and a half, really, and say, if you buy it here, this is the logical top, but the potential would be higher here because you're what? You're filtering all this out. You're filtering all that out because you is a bull. You're looking at it through the lens of a bull. And you're like, dude, I got it at the M2, reloaded at the central pivot. We're going to breach this M3 and go to M4. Cool. That's a great plan. But this technical analysis can only confirm the support, but not that you're going to break the resistance. You would have done that a long time ago. It would have done this. Wow, look at this. The drawing tool just doesn't work quite right. What's going on? Interesting. All right. I have a weird setting somewhere. What happened to this? I'll have to figure it out. Drawing tool isn't working well today. So that would have to be your trade plan, okay? That's your strategy. And the tactics, though, would have you wouldn't have gotten this, but remember, that's the big inflation number. Yeah, wow. Strange, right? Like this should have already happened, and because it didn't, it doesn't deny your strategy. What it's saying is market conditions do not predict that move anymore. And so I teach you that it will do this forever until it breaks. But the problem is you don't know the direction of the break. If the market knew the direction of the break, it wouldn't be consolidating. Okay, but most likely this consolidation has to do with that CPI news, and now we got to deal with that. And so some of the market thinks down and some thinks up, and those that don't think will get slaughtered. Okay, fed to the pigs. Okay. Coolio. Look at that, huh? Great. Potential turning point here. This really flipped last week. Okay. So things have changed. Technically, you should recognize that. Okay, you can see the breakout pullback. That's why we have these marked up. Okay, higher high. If you take my price action course, we drill this through 1,000,000 times. And the idea is if you've made a higher high, great. What's more important, though, is you're ready, willing, and able to buy a lower low. Now, you don't know exactly the price of the lower low. There's lots of things that go into that, but you know the general area. And then you look for pivots, and then you look for psych levels, and then you look for other things. But it's very predictable, generally speaking, where that's going to be. And then you get a new higher high, and you do the same thing I did here. You see here? Well, now you go. So if you believe this will continue up, then you probably bought this an hour ago. And you're like, wait, what? Yeah, right? What else were you doing? Okay, right? So we'll mark it like this. You see? So you like this? Look, that's a 1, 2, 3 reversal pattern off of your line. Okay. Okay. 1 is the double bottom. Okay. 2 is the higher high. 3 is the higher low, or what I call, to be more particular about the higher low, role reversal, which means what used to be resistance is now support. So what was the resistance? Ma. Okay. Now, on this small time frame, you see, or you should see, that you will be challenged. Well, look at this. The drawing tool just does not work today. Crazy. Guess maybe I need to reboot, huh? Let's see if this one will work. Yeah. Okay. Challenge point there, challenge point there. What do we call challenge points? Resistance. Okay. So the trade started here. You could be at the double bottom, or you can be at the higher low. And now you know where the bears are, and you're a bull. Okay. Once again, I don't know if this is going up. You need to have already filtered all of that so that you have a strategy. And when you sat down at your chair this morning, you already knew what you intended to do. Intention is key. Okay? So, once again, while I was in New York, I sat down with a professional trader, and we can, over dinner, have really a debate of what is happening now, what's going to impact the near future, and where we're going to end next year, and then kind of agree to our disagreements, right? But then line up what we both think into one logical plan. And when I said, well, if that's what you think, if I were to, go with that, I would adjust and say this thing would happen at this particular time. And then he thought about it and he's like, yeah, actually that would make sense. And now, even though we're coming at things at slightly different angles and all that kind of stuff, we could kind of line it up and say, okay, if what you're saying is true, these things would have to happen, and then I think the timing would be this for these reasons that I'd bring to the table. And then we could come to an agreement. The thing is, you understand, like, that means we have biases and opinions based on, well, research. It doesn't have to be facts. It could just be experience, which is funny because experience isn't usually the right thing. It's more like research. But nonetheless, you can have this intelligent conversation. Okay? And you're bringing something to the table, not just, reacting. You can't just react all the time. Okay? By the way, I'd like to thank the Cisco Kid, Johnny, and Joseph for meeting up with me in New York City. We had a really great time. Such an honor to hang with these gentlemen for a few hours, several hours. Pretty cool. Okay, cool. I guess we'll do gold, oil, and Bitcoin. Is that okay with you? La 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 la. Okay. So last week Okay. We were here. Okay. Then we were talking about backwardation and stuff a little bit later, but I was describing that this can come down. Okay. And gave all the reasons why. Then we were here and I said, this is the role reversal. This can go up. Okay. Now we're up here. What do you think? Well, let's break it down. Okay. That's an M3. The potential for the downside is down here. Okay. But we have M greater than 0. So this is up. That could change, but nonetheless, this is more of a sort of a profit-taking type trade. From a bullish point of view, and technically you can see this is still bullish, that your role reversal is sitting right here, and your weekly swing is right here. So if you wanted to be a bull, this is getting interesting. Okay. Okay. And you're going to say, well, Wayne, shouldn't you buy it one standard deviation below the mean? Well, if there is a trend, a true trend here, then what you're trying to do, and I don't think it's going to let me draw a line properly anymore. No, it's not. Weird. Strange. I don't know what happened to the drawing tool over the weekend. Let's do it this way. But the mean is here. Okay. So if you're using standard deviation as a potential support and resistance, okay, then your planning, technical planning, looks probably something like this, or it comes down and it looks more like that. Because we're thinking in the future, not the past, right? Okay. Similar to this, like this isn't a prediction. It's a discussion of how to set up a breakout. But you don't know if it's going to break out or when it's going to break out. That's that part. Okay. And we had this sideways. The next part of this is when you break out, so it broke out to the upside, you will have an opportunity, usually, at the role reversal. It was resistance. Then it becomes support. Okay. So now we are out of the range and we're into the trend. And so I want you to be thinking about these overlaps. What could you use if this is perpetually always plan A and always plan B? Okay, now what you have to do is think about what congruency can you find here, or what confluence could you find here? And you say, well, if I'm interested in buying at the mean with a positive slope, oh, I see that's the weekly central pivot. That would make sense. Okay. David, actually, all of those. Okay, all of those. When I'm day trading and intraday trading, I like pulling the trigger. Because I like to confirm. You can't confirm stuff with limit orders. All you get is price and time. But you can't confirm like reversal pattern at the right price and at the right time. But I do a lot of swing trading and a lot of overnight trading, and I just can't be there at that time. So yeah, I'll throw down limits. Okay? And those are the pros and cons. Okay? But like, do you guys think it's reasonable that you could have a trade plan to buy this at 92.50? How many people here, based on this basic information, that this is still technically making higher highs, and that technically you want to buy a higher low, and that this is very plausibly a reasonable price, not to pull the trigger or not necessarily for a limit order, but to at least look for a buy? Okay. Then you drop into the smaller time frame. And you'd be staring at this right now, making your decisions. Okay? And I've been teaching traders how to trap price. And there's two arguments here. If you're going to buy, this is your first, and your second is right here. So your first entry is here, your second entry is here, and now you're Oscar Mike on the move. Okay. JR, I try every day. I'm here. I've been here every day for almost 20 years. I think for 16, 17 years, I guess. So you can keep coming every day and I'll keep trying, or you can pay $88 and join FX Bootcamp. So you can come every day, or you can, by the end of the week, probably be a very significantly better trader as far as your knowledge. You still have to put in the time to get the skills, but if you're a beginner trader, again, think about it. You can be here every day for a year, and I'll do my best to help you. I don't really care about the $88, but you need to pay it. The second thing is, right, where you pay the $88 and you just get a year's worth of experience by the end of the month. Your choice. Okay? Yeah. I mean, I know it's a sales pitch, but whatever. Pay the money, dude. Right? Like, right? Yeah. And there are people in the room that paid $1,000 and they're probably pissed at me. Okay. So on this smaller time frame, you see the price action is currently not bullish. So you need to make your decisions, right? A bear is going to look at it that way. But remember, you're coming in and you're saying you don't believe it's going to be bearish. Or actually what you're saying is, if it were to turn bullish, it would be at this price. Okay? Because your second plan is down here and later in the day. Thank you, Daniel. Okay. Okay? So really, if you're trying to kind of scalp your way into this, you're looking for that. If you got a problem, yo, I'll solve it. Check out my hook while my DJ revolves it. See? Remember what I said. If you're scalping your way long, not because of the price action, you're using the price action to confirm your strategy. Do you understand? You're not doing it because of the price action. The strategy came first, and then the price action is in there, right? Yeah, sure, JR. Kevin, you're saying you get more out of $88 than you got out of a $30,000 investment? Holy smokes. Holy schnickerschnocker, eh? Yeah, sure, Patrick. Yeah, there's it'll complement it. There's one trading program which I think is about 8 hours long that follows the book. Yeah. Yep. All right, so that's that. We have gold. I read some good research out of the CME group over the weekend. Yes, even though I was traveling, living like a rock star, I still took time to do fundamental research. So anyways, there's a great report of how gold performs over periods of balance sheet reduction by the Fed. Oh, that's good to know. Yeah, and that's mine. I did the work. I'm keeping that for myself. Cool. Okay. So we're getting to the top of the standard deviation with slight bullishness built in. These pivots are not incredibly important. I mean, you might argue that that bottom is in play, and therefore you are targeting 2,000. Some change. Not much higher. Like, not 2,100. So, in that case, you would play it, if you're a bull on this, you would play it of you're now in the business of buying dips. Sure, Patrick. Yep. Okay. Okay, nice, right? So what's good about gold? Typically, it's an inflation hedge. What's bad about gold? Doesn't pay you interest. If you own physical gold, it has a lot of carrying charges, carrying fees. It's expensive. Okay. So you want to think about these things. Start, Matt, with central banks. Okay. Yeah, but the cost there, of course, Patrick, is the risk that one day it's all missing. And that's a cost. Notice the price action we have going here. See how we had the higher high, and I dragged this across to simulate where the general idea for a higher low roll reversal would be. Okay. We have it trapped here. Then there's a breakout, which means you look for the pullback. There was definitely a pullback in there. They made a higher high. We took this across. Once again, there's the higher low. Made a higher high. Took this across. Once again, there was a higher low. Okay, made a higher high. We have all this volatility. It's all going ape crazy. Nonetheless, still made a higher low. Now it's definitely made a higher high and is setting up a higher low. Now, you might have done this and thought it would fall a little further. Hey, I don't blame you, man. This is a big move. That's a giant move. Okay? Barely, you could hardly even call it a 382. Okay? But I want you to see the consistency of what's going on here. Okay? And I also want you to realize that not a lot has happened for a very long time. Okay? And that I wouldn't be too eager yet. Yes, it's going up, but it hasn't had a clean move. Another way of looking at it is the average daily range, or just the general range, has been very tight for a very long time. And I would not be quick to assume we have a new trend. But do what you got to do. Okay? Right now, I'd look at the current sort of low, and I would look at the current sort of high, and you'll see that our pivots have already done the work for us. M2 is where bulls buy. M3 is where bears sell. Okay? And that's basically what's happening. Okay? Bulls bought down here. And the theory is bears are going to sell here. Okay? That you're not going to see 1900 on this. Okay? But maybe in a month, you can buy it back here at 1850. And breach it then. Could be a rabbit, could be. Okay. How about biddy? Biddy, 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 can't you see? Okay. Yep. Okay. Technically, this is not good for Bitcoin. Technically, this would do this to this. That's what the chart says. Okay? What you might be hoping for, however, is 46K. You might be looking at a daily, not an hourly. And what that chart might say is this to this to this. Okay, so let's take a look. Let's get off the hourly, look at the 4. And what I just said to you was this. Okay? Some would argue that we're actually on our way to 50,000, not 46,000. So that's what would be in play. Okay? See, if this is a higher high, I want you to look left, find the old resistance, drag it across, and that's the new support, and now you hit your target. Okay? And that's what that says. That's what it says. It's not my opinion. That's what it says. If you're a bull, that's what it says. Doesn't tell you to be a bull. Doesn't tell you to be a bear. You should already know that. So Matt asked about fundamental analysis, and I said check out central banks. The other thing I want you to check out would be the balance of trade of every economy you study. Is it a net importer? Or is it a net exporter? Okay. The United States is one of the largest net exporters in the world. If it's not in the top 3, it might actually be the number 1. It exports an unbelievable amount. It just happens to import $900 billion more than it exports, which ain't no small amount. So you want to look at net imports. And then if you're smarty pants, okay, where does it go or where does it come from? For example, the United States of America, its largest trading partner, okay, where does the United States get most of its imports from? You're probably thinking China. That's number 2. Number 1 is Canada. Okay? So on and so forth. Okay? I prefer the goat than the bomb. Bomb is so destructive and goats are cute. Yeah. Over here. Yeah. So on and so forth. Just like do some research. Okay. Enjoy it. So anyways, Bitcoin, if you think Bitcoin is going to $100,000, I'll say, I don't disagree with you. I would just argue that it's not happening this month, but you could potentially get halfway there. So Patrick says, so the US dollar should not always be so strong. It should not be so strong. Now, this time of year, often it is, but the question is it unusually strong? And if you think it could be, the next thing would be why? Well, we're at 0% interest rates, and many people think we're on our way to 2% this year, next year. Could that be why? Could it be, okay? Could it be geopolitical risk? Okay? The press, the media is telling me that Putin will attack. Maybe today, maybe tomorrow. Very soon, it's going to happen. And that Putin is a bad man. Okay? But they never say, wait, is this America through NATO setting up shop in the Ukraine? Okay. Well, what's the big deal if NATO forms in the Ukraine? Well, what was the habitual here. What was the Korean conflict about? Okay. It was a United Nation action. It wasn't war. I believe Vietnam was a conflict and Korea was an UN action. So it's not even a conflict. But what was that about? I'll give you a heads up. So it was a United Nations action of which probably 98% of everybody were Americans. But it wasn't America. No. It was the United Nations. All right, cool. Within 1 month, within 1 month, maybe 2, I'll say 2 months. Within 2 months, the USA, United Nations, USA pushed all the way to the Chinese border. Just overwhelming and overrunning North Koreans. It was easy. Did you know that? They showed up in the summer and they were planning to be home by Christmas. I mean, they showed up late. They probably started in, maybe it was 3 months. They attacked in September and we're going to be home by Christmas. And it was like November and they're already just completely, they're in northern North Korea. So how long did the Korean War take? How long was the North Korean War, for lack of a better word? The Korean War. Sorry, I keep saying North Korean because I love South Korea. Okay, it was 3 years by the time they signed the armistice, created the DMZ. Okay, so why did it take 3 years, guys? If in 3 months or 4 months, the United States completely overwhelmed Communist Korea, completely overwhelmed them. It wasn't even close. What happened? 1 million Chinese soldiers came over the border. The Americans dropped everything. They left supplies, weapons, guns, tanks, everything. They just dropped everything, got in the trucks, headed south as fast as possible. Okay? Then it went on for 3 more years, and they just cut the country in half, called it South Korea, North Korea, created the DMZ, the demilitarized zone. It was a stalemate. So what was that all about? If we had completely annihilated the North Korean army, or the Communist Korean army, in just a matter of months, why did it take 3 years? Why was China in this battle? They wanted a buffer zone. See, okay, North Korea sits right in front of the Chinese border. So if you're going to try to land an army and then attack China, you have to go through North Korea first. It's a buffer zone. It's the new Great Wall of China to keep out invading armies. Okay, why did the USA open their nuke bays and then send out the U.S. Navy? I'll just put Navy. Why did they and set up a blockade? When they found out the Soviets were building nuclear bombs in Cuba. Why? for essentially the same reason. Needed a buffer zone. Can't have a bunch of nukes right on your back door. Can't have an invading army, so to speak, a threat at your back door. You're like, are you joking? You can't do that. Well, that's what Korea was about. You're like, no. We can't have our enemies living on our border, ready to attack at any moment. You're like, that's BS. We can't allow that. It wasn't, the Chinese didn't like, they didn't like it for Korea. Okay? The Americans didn't like it with Cuba. And so now, do you think Putin likes NATO on his border? His enemy, his adversary on his border? Okay? Did you know, who was it? James Baker. You guys remember him? The Secretary of State for Reagan. James Baker, Secretary of State. Okay. Told their adversaries that they were not going to build NATO in the Ukraine. So how do the Russians feel about that? Sure, that there would have been Soviets at that time. And maybe I'm off. Maybe I'm off a Secretary of State. But I think Albright was after, right? Albright was after? No. Was it Albright after James Baker? Anyway, so it wasn't Madeleine Albright. So anyways, around this period, I believe the Americans said they're not going to build NATO here because they know the problem with it. Right? There's a problem. And so anyways, I think what's happening is we're setting up shop in the Ukraine. And he's reacting the way you would think. So, anyways. Is it as bad? Are they really going to do it? Or is it really politics? I think it's much more politics. But, okay. But he already has Crimea. 40% of the population will tell you they're Russian. So who knows what's going to go down there? But the issue is, does that uncertainty and that geopolitical risk carry some dollar strength with it? Yeah, sure, why not? How does the Canadian trucker convoy affect the market? Well, 8,000 trucks are supposed to cross the bridge between Detroit and Windsor, Ontario every day. 8,000. Essentially zero in making across right now. On those trucks, very often are things like semiconductors or car parts used in the manufacturing of cars, to be very specific. Canada produces a lot of cars and sends them to America. So, what's the response? Every single car manufacturer in the region has shut down their factories. Okay. So do you think, right? Does that have an impact on both the Canadian and American economies? Yeah. 8,000 trucks a day. Now, some stuff maybe are worth flying in an airplane, but I bet you many are not. Like there isn't an alternative. Okay. So is that good for Canada or bad for Canada? Well, it's not good. But for those that are in the convoy, they may believe that their reasoning, and I'm not here to judge that, but they may believe their reasoning is good on the long term. And they know they're creating problems on the short term. Okay. But here's the interesting part. Okay. I heard in some report or interview, I might be wrong in this because it's third party, I haven't checked it, but I heard it's 10% of the truckers that are impacted by what they're protesting against, which are vaccination requirements. So 90% of the truckers are just fine. They could just drive across the border every day, back and forth, doing their job, and 10% cannot, and the 10% are blocking the road, putting the 90% of truckers out of business, but also shutting down all the car factories, putting them out of business, so on and so forth. So, okay. So it's one of those things. Okay. The 80-20 rule, right? So on the short run, maybe it's bad. Maybe on the long run, it's good. Could be. Okay. And so Big Fella says if they lose, it will be human extinction. Okay. That would be a hard point of view to argue against. Okay. So anyways, yeah, not for me to comment good or bad. Taking a look at South African Rand. We have this planned out. Remember, there's traps. Sell it here or sell it here. Okay, very nice. You can see the trend. Cool Modi. Okay, this looks caught here, but look at the trend. It's not pretty. Okay. You can live on it, but it tastes like shit, to quote the great Crocodile Dundee. Okay, maybe take a look further back. Just slowly doing its thing. I think what you should do is find the time frame that you find to be best for the analysis here. Because very often I find people are talking themselves out of these trades. because in the short run, there's a lot of volatility. I think you're going to find over the year, we will have continued volatility. So I want you to figure out the best action as far as your trading demeanor during a period of extended higher than normal volatility. Yep, the big fella. It's just like, it's such a strong statement that there's no argument, right? Like that's the point. I'm like, I couldn't reason you out of a statement like that, right? But it could be hyperbole. It could be. It could be. It'll be the end of civilization. Probably not. Yeah, no, I know. So anyways, just taking a look at that. Like it's doing all right. It's chugging along. Yeah, but mate, that's generally true always, I believe. Okay. So again, I want you to think about this. Seriously, truly. I want you to think about this. What if volatility stays above normal levels all year? Okay. Well, the next big thing, Meta, that Americans need to prepare for, and I don't mean like stuff food in a Yeti cooler and then bury it in a cave, but at some time, and potentially in my lifetime, and almost certainly in my children's lifetime, the United States will not be the reserve currency. Okay? Much like the Great British Pound used to be the reserve currency, and then very quickly it wasn't. So is America prepared for that? And generally speaking, no government has ever been prepared. And I don't know anything about the individual people. But it's one of these things, like if you thought it was inevitable, maybe you should prepare. But maybe because it's inevitable, you don't prepare. But I'm not sure. So, but it's likely coming. Now, is it going to impact us as currency traders in the next 5 or 10 years? No. But like this idea, like let's say, for example, something like Bitcoin is a true competitor. Okay? Better than tulips, I would say, right? But anyways, like, what if it does? I'm not saying it is, but just out of a thought process, because it's not going to be euro. I thought it could have been. I thought when the euro first came out, I thought we were going to go to a dual reserve currency system. And on paper, that made a lot of sense. But very quickly, it was clear that it would never work. And it won't. And that's dead. It just wasn't made correctly. Okay? It's flawed. The way it was created was flawed. So that's dead. So the next thing is, well, what about renminbi? Okay? Yeah, okay. Not anytime soon. Maybe in 100 years. But I'm thinking, well, more likely, if we're talking now 100 years, maybe the fiat currency system itself collapses. And that there isn't a fiat currency system. It's a combination of like a gold standard / crypto standard, right? SWIFT goes away, cash goes away, all that kind of stuff. Well, that's what renminbi, yuan. Okay. But the thing is, so like Big Fella says, the Chinese yuan will be the one and only currency. I don't think so. I think it's too late to come up for them to come out with a fiat currency. But I'll tell you, you need a very open rule of law, which they don't have. You need a deep and liquid bond market, which they don't have. Okay? You need a free floating currency, which they don't have. But yes, they will have a very large economy. But no, they will not be a reserve currency. Now, things might change, though, if they start using their currency to buy oil instead of the US dollar. That could get interesting. But I think much more interesting, because I think when people make the argument of the yuan being the next reserve currency, typically they don't understand what that means. And so I can just go through those basic things. But also they're looking backwards and using the old model of what happened over the last 500 years. They're like, well, this is likely to happen next. And I would say, well, most likely what happens next is nothing like what happens in the last 500 years, and that maybe all paper money goes away, and that central banking needs to be redesigned because of the failure of the last 500 years, and that we're not just going to have a new regime, but we have computers now, we have technology now. So we're not going to replace the Great British Pound and the Deutschmark with the US dollar like they did at Bretton Woods. Instead, it'll be more like, okay, what will the world do as and then when the US dollar loses its status as a reserve currency? What would be the next regime? And probably not just a new regime. Of let's do the same thing, but now everyone will use yuan. Not likely to happen. So it'd be more likely to be crypto, I think, or a form of crypto. But crypto is so young and babyish right now. You might freak out if I say crypto and you're like, crypto, there's no way. Just like settle down, dude. Over the next 25, 30, 50 years, do you think that that industry will mature? Yeah. So the world... Remember, brilliant minds over the entire planet are working on crypto and blockchain. And if you add 25 years of the planet, of all of humanity represented in the creation of a new system, that gets more interesting. And you're like, but how would that work? And how would this do? And what? Well, think of it this way. We've already had a system like this. Okay? There was a time, let's say 100 years ago, okay, where we used gold. Gold was the universal currency, a reserve currency. Okay? It's just a physical thing. Can't just make more gold when your economy is in recession. Oh, we'll just make some more gold. Okay? So instead, there could be a digital form of that. I'm not saying digital gold, but I want you to think of it that way, where there could be just a global standard. Okay? Whatever. Or just be, okay? Or be okay with boom and bust cycles. And the issue usually comes from these boom and bust cycles and the government stepping in the way for the greater good. And at the end of every civilization, doing that for the greater good has collapsed the entire economy and made their currency worthless. Because the bust is too painful. And they don't have any more gold. And they don't have any money in the vault, or at least not enough money in the vault to support the entire economy during a bust. So they borrow and print because they believe it on the long run, it's better for the greater good, which is certainly true. The problem is it's bad if when times are good, you don't pay it back. And that's the issue right now. Not right now. It has always been. Okay? Is that the governments, especially reserve governments, see that their debt is cheap. So when times are bad, they spend like crazy. But when times are good, they spend like crazy. Okay? In 2008, we tried some amazingly aggressive, radical ideas to save the United States. And truly the world, but let's just focus on the United States. And I believe it was John Paulson and Ben Bernanke went to Congress and they said the entire financial system is going to collapse. Now wait for this. We need you to give us $300 billion. And people had never heard of such an outrageous thing. $300 billion. And then they're like, and we might need a couple $100 billion more. We're not sure. They're talking hundreds of billions. We just spent and the central bank put $5 trillion on their balance sheet in a matter of like 5 or 6 months, right? Crazy. And the government borrowed and printed another $5 trillion in response to COVID. Back in the day, back in 2008, we were talking about hundreds of billions, and there was pushback, and Paulson and Bernanke had to go back like 2 weeks later, and they're like, we need $900 billion. And Congress is like, why $900 billion? We're still trying to work on this 3, 4, maybe $500 billion. Why did it double? Because you're taking too long. And they're like, holy shit. Okay, we'll give you $900 billion, but we can't even conceive of $1 trillion. Do you understand? Like, it was just so radically insane to think of $1 trillion. And now it's like, oh, you need $1 trillion? Oh, yeah, no problem. Oh, another $1 trillion? Sure. What's it for? Oh, don't even ask. Just, shit, here's another. Just take an extra $1 trillion just in case. Like, it's crazy. It's insane. So the Fed, when I talk about the balance sheet reduction, the BSR, okay, we're talking about $4.7359 trillion needs to come off that. Okay? It's incredible. And that, my friend, is why central banks are so good. they can take the money back. Oh, there's way too much money. Well, we'll take some back. What is because that's what the central bank does. How will the central government take its $5 trillion? If there's too much inflation, you want to remove the money supply. So how's the central government going to do it? They can't. And this is the part that will lead to the collapse of the reserve currency regime. Because they borrowed it at nearly 0%, which means that money is worthless. Do you understand that? Like literally, the interest rates were 0, and they borrowed $5 trillion at the interest rate of the US dollar. See, if someone else had to borrow, it would be different, right? But anyways, so this money is actually worthless. It was worth 0% interest when it was borrowed, but it was also given to people for free. Now, only a high percent, okay? A percentage of it was free, and a percentage of it is for bridges and roads. Here's the problem, though. Do you remember Obama had, I think, $1 trillion earmarked for shovel-ready projects? And if I understand correctly, it was never spent. But anyways, so a certain amount of this $5 trillion went to bridges and roads and airports and solar farms and wind farms and all that kind of stuff. Great. All of that is great because we call that infrastructure. And what does that produce? A return on investment. R-O. I did put RON. Return on investment. There will be a return. You'll get 100 years of use out of a bridge. You get 30 years of use out of a road. You'll get 100 years out of an airport. Okay? You'll create electricity out of wind. And electricity is money, but it's all very productive. There's a return on investment. Okay? But giving people free money helps them out of a bad situation. There's no doubt about that. But there's, 0% ROI. Because after you pay rent for 6 months and buy groceries for 6 months, what happens later? Nothing's changed. You see? What percentage of those people are working right now? I don't know that number, but I know, I think it's 4 million people that used to have jobs, don't have jobs. Okay? So if those 4 million people got the money for free, there's no return on investment. And right? So what happens is that is a bad investment on the long run because there's no return on investment. Okay? It's like going to a car dealership and the dealer says, yeah, this car is a lemon. It's not going to work. It's broken. It's totally broken. It looks nice, but it's totally broken. Never run. Do you want to buy it for full price? Yeah, totally. And you know it doesn't work, right? Yeah, this car doesn't work. But I'll pay full price. All right, cool. Okay. So again, the social security or not social security, but having the social safety net, let's say, on the short run is really good. But you gotta there's got to be a point where it stops. And at a point that there is a return on investment. So not only do people get jobs again, but they're better jobs and all that kind of stuff. But the inflation comes from the $5 trillion minus Build Back Better, if you want to call it that. Okay, the infrastructure side of Build Back Better, not the social infrastructure side, but the actual bridges. Like, if you can build a wind farm, I'm cool with that. Okay, there will be a return. But you take that, and what's left is inflation. And you can't take it back. Unless you do what? What's the one way? See, if the Fed could just sell off their balance sheet and remove the money from the system, how could the federal government remove this inflation and kill the money supply? What's the one way? What's the way they always do? They meaning governments. No, Matt, the government doesn't raise interest rates, Matt. Taxes. Okay? So they're going to raise taxes now to take money out of the economy and slow down inflation. But what's the problem with this? People that pay taxes are productive. What happened? They work or they employ workers. They work or they employ. They create value. They wake up in the morning, they create value, and then they're taxed. So the ones that got the free money have 0% return on investment. And once the money is spent on free rent and free groceries, then what? There's no money. They won't pay taxes. So now we got this probably $3 trillion of too much money. So they're going to raise taxes on the workers and the employers. Which is an incentive for these people to leave. Okay? But I think if you study what happened in other places in the world, you'll find out that that's relatively normal. Okay? Well, I'm not taking it from a political standpoint, guys. I'm taking it from an economist's point of view. So it's not my job to say, hey, you gave some people money for free and there's 0% return on investment and that's bad. I'm not saying it's bad. I'm saying it happened. Okay? And it leads to a problem where if there's no productivity for the dollar that was borrowed, let's say, because the United States borrowed the money and then gave it somewhere. Well, if you gave it towards building wind farms that create clean energy, well, it actually creates electricity, which has a value attached to it. So you could say, well, this created $1 billion worth of, will create $1 billion worth of electricity every year for the next 50 years. And you're like, okay, well, that was a good investment. But it also provides, I forget it's an external cost of having pollution come from a coal plant. Externalities, right? So you're removing some externalities, and there's a return on investment. There's a return to have clean air. Now, it's harder to measure, and very often you have to measure it by saying it's less bad than this other thing. But there's another way of looking at it is there's lots of good of having clean air. Okay? And again, it's not an argument of global warming and all this. Just there's a positive benefit to society to have clean air and beautiful blue skies while you're golfing on your golf course that sucks water all day, right? So at least you have clean air, right? Cool, right? So like there is a return to society, there's a return to capital, but there's a measured return. Okay? So again, I'm not saying politics, but there is also on the short run some sort of return to not have all of society collapse on the same time and there's blood in the streets and war and riots and all that kind of stuff. So in the short run, stabilizing the economy is good, but typically it's done through the central bank. Okay? And the central bank could easily take the money back. And the problem with the central bank, though, is it has to trickle down through the economy. It has to go through the money creation process of the interbanking system. And remember, the central government doesn't give poor people money. It gives cheap money that businesses can borrow so that they can hire workers and create demand, and therefore by creating demand, they'll need workers and all that kind of stuff. And maybe the government should step in and say, we're going to have unemployment for everyone, right? And we'll extend it. Instead of 13 weeks, we'll make it 47 weeks or something. And that is a transfer payment. There's no productivity. It doesn't count it in GDP, but maybe somehow it just, the short-term stabilization is good. But giving on top of that free money to wide swaths of society from not the central bank, but the central government through borrowing and printing, and then later on paying for it through higher taxation, that actually historically is a really dumb idea. But it's really good for politics because on the short run, it can get ugly fast if you have 4 million or 10 million or 30 million people not paying rent at the same time. That can get bad too. Okay? So we know through history that these decisions have been made before. And almost always, if not always, the central government, again, not the bank, the central government makes the same choice. Let 40% of the population suffer or bail them out. And it's always better and I'm not even saying it's the wrong decision. I'm just saying it does have consequences. So they do what is needed on the short run, but the problem is it does create very, very, very big problems. So now if we get through this next 2 period, don't be shocked if taxes go up or those that are in power lose their power. And that's what's good about democracy. What'll happen likely is if I were to predict, and again, I'm not being political, I'm trying to put this into sort of an economic context. The decisions that were made have been made, and that's that. It's in the past, but there's a toll. It has to be paid. So what is likely to happen, guys, is I'm guessing, and again, I'm not being political, this is an economic thought process, Biden will not be reelected. Because what will need to happen is he will need to raise taxes. It's the same way the Fed needs to raise interest rates and lower the balance sheet by selling off $3.5 to $4 trillion worth of assets. Dude, that's a lot of selling, my friend. That's going to have a lot of negative consequences on the short run. Okay? So the central government now, not the central bank, but the central government's going to have to come in. How are they going to pull their money out? Because remember, they also increase the money supply. How can they do it? Raise taxes. It's the only way. And then do what with it? Pay down the debt. Pay down the debt. Raise taxes, pay down the debt. You know that that's what should be done. If you were going to do it and have any chance of redemption, you would raise taxes, take 100% of that, and pay down the debt. Because there is a return on that. You're increasing your credit worthiness, right? And you're lowering the cost of debt. So it's like consolidating your credit card debt with a cheap loan and getting rid of all the 20% payments, and you drop that and then over time pay that down. And you're like, well, it's not making you money, but it's saving you money, which is a form of productivity. Could be argued, right? So we jack up taxes, not on poor people, but on the rich people, but the rich people, whatever. So anyways, so now let's say $500 billion a year or $1 trillion a year has been collected by increase in taxes, pay off the debt by $1 trillion. But that won't happen, as Wes says. That won't happen. And it's never happened, which is funny, right? Like there could be a shot at redemption, and maybe it works out of a wise business model, but that's not likely to happen either. But what'll happen is a different party or a different leader will come out and say, no new taxes. That's usually what happens. Okay. So whatever. So it's thought. Like, think about it as money. Okay. It's interesting, right? So if there's too much money, how do you know there's too much money? That's what inflation is, son. See, look, I don't care about 7% of inflation. If we have 9% GDP, it wouldn't matter. The word for it is growth, but I want you to think of it as something different. It's productivity. Okay? If your productivity is growing by 7% or by 9%, I don't care about 7% inflation. But right now we have like 5% growth and 7% inflation. What does that tell you? How is that possible? It's not possible. I want you to really think about that. Wait, how can we be more productive? Or sorry, how can there be more money than productivity? So if you work for me at a factory and I own the factory and I buy all the material and I buy all the machines and you get all trained and you come and work at my factory and then we make these stuff and then I sell it and we sell it for higher than our cost and we have profit, and then I pay you based on your contribution. So like senior managers make more money than a junior apprentice and all this kind of stuff and everything. And if we can become more profitable as a company, I can hire more people. I can afford to pay more people. But the thing is, do you understand the tie between the income that the company earns and the income that you earn? Like, if we stop making widgets and gadgets, or if people stop buying our stuff, we go out of business. Why? Well, we were productive, but we made things that nobody wanted, or we were productive, but our costs were too high. But if we make things that people want, and we make them well enough because we're all thinking entrepreneurially and we're finding better ways of making it and lowering our costs and increasing our efficiency, that we offer some sort of value to somebody. You see, in exchange of value, they give income, and in exchange of your work, you get an income. And this is all tied to income. Income and productivity are one and the same. This is like, I want you to think about this. This is, I think, really important. Gross domestic product is equal to gross national income. Your productivity is your money. Okay, when you're productive, you earn income, and your income is put to productive uses. You buy products and services. Therefore, people have a job and they earn income. GDP and GNI are equal. They're the same thing, just measured on different sides of the receipt. So how can you have more money than productivity? Right? Again, how GDP is less than GNI? How is that possible? Somebody got paid when nothing got produced. You see that? Again, I'm trying to explain sort of what happened through economic principles. GDP and GNI are the same. So how is it we have more money? This is inflation. How is there more money? Because somebody got paid for doing nothing. Now, again, that sounds like a negative comment, and it kind of is. But what I don't mean it that way. It's the government had to make choices to save the economy. To say people lost jobs overnight. It was terrible. Okay? But I want you to think about it like the reason we have 7% inflation and 3 or 4% growth is that the income is higher than productivity, and that's unnatural. So in the long run, or maybe even in the short run, we need to reduce the income. The Fed can sell bonds and reduce the amount of money they created. And how will the U.S. government do it? They need to raise taxes and pay down their debt. And the question is, will they do it? Okay. So again, I'm not trying to be political, but I am trying to show you economics and how you understand the situation we're in and what needs to happen next. Forex says, how long until it goes back to equilibrium? Well, we don't know. What policy is the U.S. government doing right now to take money out of the economy? Nothing. Okay? Now, this U.S. central bank is embarking on a policy of making money more expensive to borrow and taking cash out of the economy. So that's one thing. But that's only 50% of our problem. No. So the taper is already started, but that's not balance sheet reduction. Okay? That's slowing down of balance sheet increases. So we're at the end of that. That's QE. What balance sheet reduction is selling bonds that they already own. So quantitative easing is buying bonds. Balance sheet reduction is selling those bonds back. And of course, when somebody buys the bonds from the Fed, they have to give the Fed money, and the Fed takes it out of circulation. Okay? So Forex pivots, how do they give the money back? Okay, let's talk about quantitative easing. I hope you don't mind me going long today and giving you. Okay, quantitative easing. The Fed. Wait, let's do it this way. Is this okay? I go a little longer? Okay. QE. Fed buys bonds. Okay. So you get a situation like this. Okay. Interest rates. We'll do interest rates and the quantity of money. Okay. This is supply at Q1, quantity 1. Why is it vertical? See, typically you see things like this, right? Demand. I keep changing colors. There we go. And supply, right? Why is this one vertical? Because that's how much money there is. It's not a curve. How much money is there in circulation? That much. At all interest rates. That's how much it is. Now, you can make it bigger by shifting it to the right. So, quantity 1, 2, 3, 4, 5, 6, 7, 8, 9, whatever. That's the quantity. 1, 2, 3, 4, 5, 6, whatever. And that's interest rates going up. Quantity higher, quantity higher. Okay, now we're talking about the demand for money. Demand looks like this. And you're like, okay, so how do you explain this one, Wayne? Demand for money at 4% is whatever it is. But when money is cheap to borrow, demand is higher. And when money is expensive to borrow, the amount of money demanded is low. Think of your credit card. Okay? You get a teaser balance and they're like 0% interest for the first 6 months. You're like, yeah, money's free, baby. And you demand a lot of quantity of money. You're putting stuff on your credit card like crazy because it's free. And then it jumps to 20% and you're like, oh shit. And you stop spending. Okay? Okay, that's great. Nice. So this is what it looks like. And what this chart is saying, at this quantity of money demanded, the interest rate is 4. So at 4% interest, you will demand this quantity of money. But that's all there is. That's all the money there is anyways. Okay, that's where it is. Okay. So the Fed buys bonds. Where does the Fed buy bonds from? The U.S. Treasury or from J.P. Morgan? By the way, if you like this stuff, you need to join FX Bootcamp. You're going to get a lot of this stuff. You will be able to do this in your sleep. Wes, you have to be more specific. Okay. Remember what the Fed is trying to do, put money in the economy. So if they buy it from the Treasury, where the bonds actually come from, the money would go to the government. And nothing would happen. It wouldn't go to the economy. It would go to the government. They don't want to do that. So it goes to bond dealers like J.P. Morgan, Bank of America, so on and so forth. Okay? They go to institutional banks, bond dealers. But I want you to think Bank of America, JP Morgan. Okay, Wells Fargo, that kind of stuff, right? Bond dealers. So JP Morgan knows that the Fed wants to buy bonds. So what would a smart criminal, what would a smart banker do? Go to the Treasury, buy bonds. For X dollars. X dollars. Okay? Then they call the Fed and they say, hey, Fed, do you want to buy some bonds? Fed says, of course we do. Sells it, okay, X dollars plus 1 for profit. Arbitrage, guys. They already know the Fed, okay? In fact, it could go down like this. It could go down like this. The Fed calls JP Morgan. We want to buy $1 billion in treasuries. So JP Morgan's like, hang on a second, puts them on hold, picks up the other phone, calls the Fed, calls the Treasury. We want to buy $1 billion worth of bonds. So JP Morgan gives up $1 billion and gets bonds. So they're short cash, long bonds. Okay? You see? Okay, now what? Then JP Morgan takes their bonds and then sells them to the Fed at a profit. So now they're the opposite, right? Now they're long cash, short bonds. They're literally selling the bonds they just bought 5 seconds ago. So they're short. They're selling. Now JP Morgan is selling bonds to the Fed for a profit. But they waited until they knew the Fed was going to buy. Absolute total free money. But what happened? The Fed gave JP Morgan $1.1 billion for the bonds JP Morgan just bought for $1 billion. So what happens now? That money is in the economy. And where are the bonds? On the Fed's balance sheet. Okay. Cool. So what has occurred? Money supply is increased. Okay. So we shift this to the right because that money didn't exist before. The Fed now bought those bonds and put the money in the market. And what has occurred? Interest rates have fallen. Right? Well, Forex Pivots says Fed isn't a smart shopper. Hey, doesn't matter to them. It's free money. It's not real. They just invented the money. Okay? So anyway, so now it's there. So the Fed invented the money, but they can take it back by doing what? The opposite. They sell bonds. Okay? Right? And they put it back, let's say here, supply 3. And what's happened? Interest rates will go up to this level. Interest rates are up. Supply is down. And the amount of money demanded is lower, so it slows the economy down. But the thing is, they did the opposite. Okay, the Fed sold the bonds. JP Morgan buys them. Okay, JP Morgan buys bonds from the Fed. Okay. Now the Fed gives them an offer they can't refuse. It's fine. They're going to make a profit on it. Don't worry about JP Morgan. But what does JP Morgan have to give up if they're going to buy these bonds? Okay, JP Morgan is short cash, long bonds, right? So this money now comes out of the economy, and that's what shifts money supply from 2 to 3. The cash comes out of the market and the money supply shrinks. Interest rates go up. Inflation goes away. So that was no problem for the central bank. That's why in 2008, the central bank did more than any central bank had ever done in the history of the world. And we had zero inflation 14 years later. We never had inflation. But this time, we have $5 trillion that the central government produced, either by borrowing or printing. Okay? And in that case, how are they going to retract it? If the Fed can easily do it, the Fed can't do enough to lower interest rates or to lower inflation. That's why you've never heard them say it. The Fed can't do enough. So the central government's going to have to raise taxes and pay down their debt. But you know that story. Easier said than done. So Forex Pivot says, yeah, well, factories leaving the country due to higher taxes. How can the higher taxes be paid if exactly this is the problem. Okay? It's the idea of free money to low productive parts of the economy and then taking money away from highly productive parts of the economy. On the long run, that's just a really dumb idea. On the short run, it might be incredibly necessary to support human dignity. But economically, on the long run, there are consequences, right? So if you jack up taxes on productivity, then productivity will find somewhere else. And that has happened. I'm not like predicting anything that hasn't happened over and over and over and over again. So it's just, I don't know. It's just an economic consequence. It's a consequence of the economic decisions. And by the way, finance is the study of cash flows. Economics is the study of scarcity. It's a social science that studies scarcity. Okay? So there's a consequence to the scarcity here. What the government should do instead is find a way to get 4 million people employed. Roosevelt, right, created millions of jobs. There's a difference between creating millions of jobs and handing out money for free. You see the difference? CCC is a great example of that. Okay. So just interesting, right? So now we're talking 100 years or 50 years in advance, but in some cases we're talking about 2, 3, 4 years in advance. So the Fed is doing what the Fed should do, and it'll have an impact. But in my humble opinion, it's not going to be enough. And of course, I'm not sure how much they know. You'd hope they know, but the more you meet people in power, the more you realize many of them are average people or below, right? Like they're just regular people in powerful positions. And so you want to believe that the people in charge are Illuminati, right? But when you meet them, you're like, oh my God, really? So I would hope they understand these things and that but they may not. And so the Fed might see inflation and want to jack up interest rates really, really, really high and lower money supply really high. The consequence to that is probably recession/depression because they're taking productive money out of the market to compensate for the unproductive money that was put into the market. Yeah, sorry, sometimes that slips out, Wes. Sometimes I'm not arrogant. What do I always say? I don't know. Anyways, walking through the airport, you don't see a lot of Illuminati. Sorry, I was just in the airport going, oh my God. And what New Yorkers must think of the world. It's so funny walking through New York. You're passing all these fancy shops and everything, and the streets are quiet, and all of a sudden you walk into Times Square and it's like a circus. It's just crazy. It's just crazy. And all the average Americans, you're like, oh my God, this place is crazy. Get me back to the Harvard Club. But so anyways, I know it's arrogant, but I'm not. It just, I don't know. The world is a very interesting place. So I hope the Fed doesn't try to use its tools to clean up the federal government's mess, because there will be massive negative consequences to that. Okay? Because I see these as two problems, each roughly $5 trillion. And if the Fed takes productive money out of the economy to compensate for unproductive money that was put into the economy, then I don't know how that math even works out, you see? So I hope they do what they need to do, and maybe we'll just bumble through the next 10, 15 years and things kind of take care of themselves. But that's a terrible business plan, huh? So anyways, that was on the fly. Sorry if I took too long. Okay. I try to be non-political as much as possible. I'm trying to teach you economics, and that the economics is a social science, and it measures scarcity. And then, of course, if you lack jobs, something needs to happen. If you lack money, something needs to happen. Right? And this idea that choices need to be made in our jobs as economists, but also as investors or traders, to understand the decisions being made and the short, medium, and long-term consequences of the decisions that have been made, so that we can seek a return on investment for our capital. Okay? That's what I'm trying to share here. And bear in mind, I can be wrong on many points here, but I'm trying to show the points that are being analyzed and thought about. So again, it's not that I'm right. I want you to think about the process in which I think. And you can go through a similar process, come out with a different decision, and I'm happy for you. And we could probably meet up for drinks and cigars and talk about it, and we could disagree with each other, but at least I can follow your logic and you can understand mine, and we could probably be great friends. So peace on earth. May the pips be with you. May your profits be above average. And I'll see you tomorrow. If you join FX Bootcamp, the link is in the description below. It's $88 a year. If you join tradersway.com, the link is in the description below. It's a trustworthy foreign exchange boutique brokerage firm, right? The link is in the description below. And if you're in my live trading group, my day trading group, I will see you this afternoon, or in the early evening, I should say. So, cheers. That just happened.